Right. So welcome once again to financial reporting. And I've already highlighted the topics for the semester. So like lawyers, we accountants are also professionals who also follow standards. We follow principles and then rules. So where the lawyers will be saying that according to Article 121 of the 1992 Constitutions, we as professional accountants, we also have our principles and laws that guides us in our preparation of the financial statements. So we don't say article blah 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 of that, but we say that according to IAS 1, IAS 16, IFRS 5, IAS 40, IAS 23, IAS 20, IAS 2, IAS 38, IAS 36, IAS 37, IAS 15. You get it? So we say it IAS or IFRS, where the IAS is the International Accounting Standards. So that is the IAS. So this is all for the semester. And we'll be starting with the conceptual framework. And then we'll talk a little bit about the regulatory framework, because for academics, it focuses on the conceptual framework. Yeah, so let's go into it, what the conceptual framework is about. So we'll finish conceptual framework quickly, then come to IAS 1, then quickly to IAS 16. So the conceptual framework. So we'll be looking at the definition of the conceptual framework, the objective. So the definition and objective of the general purpose financial statement. We'll look at the qualitative characteristics of the financial statement, the financial statement and the reporting entity, the element of financial statement, the recognition and derecognition of the element of financial statement. Also look at the measurement of the element, the presentation and disclosure, and also the concept of capital and capital maintenance. So these are the key topics that we'll be looking at under the conceptual framework. So let's quickly look at the first topic under the course, conceptual framework. So let's look at the definition and the objective of the general purpose. All right, so what is a conceptual framework? Listen to the name, conceptual framework. It's a framework, right? It's a statement of generally accepted theoretical principles that form the frame of reference for financial reporting. So it is a theory that we reference it when we are preparing our financial statement. So it's like for the lawyers, whenever they are making any judgment or whenever they are making an opinion, they refer to the laws, they refer to the articles, the 1992 Constitution, and other relevant laws. We as an accountant, when we are preparing our financial statement, we make reference to the conceptual framework. So we make reference to conceptual framework. That is a general framework that guides the preparation of financial statement. So it is a statement of generally accepted theoretical principles that form the frame of reference for financial reporting. So it outlines and guides the preparation and presentation of the financial statement. And we know that it is the SB that help in the preparation of the conceptual framework. So it is established or developed by the International Accounting Standard Board, the IAS, right? So they are responsible, or they are the board that prepares the conceptual framework. So it is based on this conceptual framework that the various standards were developed. So let us look at the purpose of the conceptual framework. What are some of the purpose? Key things that you need to know under the conceptual framework. These are the key things that you need to know under the conceptual framework. What is the purpose of the conceptual framework? You might be asked, what is the purpose of conceptual framework? So one, the purpose is to assist the IASB to develop future accounting standards based on consistent concepts. Yes, so it is through the conceptual framework that we are able to develop the standards. The conceptual framework is like a general thing, a general principles and guidelines. What I say, it gives a general guidelines. What I say, but then the standards, the specific standard that we talked about, that is the IAS 1, the IAS 16, IAS 1, IAS 16, the IAS 40, and the other IAS standards are the specific standards. So,
I say you know you also
right. So the conceptual framework helps us in developing the various standards that we talked about. That is the IAS 1, IAS 16, and the rest. So it's like is that it assists the IASB, the board, to develop future accounting standards based on consistent concepts. So it helps in the preparation or setting out of the standards. It also assists the IASB to develop consistent accounting policies when no standard applies to a particular transaction or event. Yes, so the conceptual framework also helps us to apply to specific transactions when there is no standard for it. You see, the IAS 16 talks about PPE, property, plant, and equipment. When you look at the non-current assets, I believe under the accounting 1 and 2, we saw something like non-current assets, right? So under the non-current assets, we have the property, plant, equipment, and the rest. So the IAS 16 talks specifically about property, plant, and equipment under the non-current assets. So the conceptual framework is there to guide us on a particular transaction when there is no standard for it. So we already have a standard for IAS 16, which is talking about the property, plant, and equipment. So if there is a particular transaction that you don't know how to treat it, there is no specific standard. Like there is no standard. We have a standard for inventory. When you are treating your inventory, the specific standard is IAS 2, which helps you to know how to treat the inventories. But then assuming we have a particular transaction that there is no specific standard for it, how are you going to treat that transaction? So that is where conceptual framework, which is the mother framework, it gives the general overview. What I said, it gives the general overview. So if there is no specific standard, the conceptual framework will give you the treatment of that particular transaction. Also, it also assists users of the financial statement in interpreting the standard. Yes, sometimes you have a specific standard that you don't know how you're going to explain it. How are you going to? So the conceptual framework, in addition to the RPGs, would help you to interpret various specific standards. So when there is a standard, sometimes you have the standard, but you don't know what the standard is about. You don't actually understand the standard. So the conceptual framework would assist you in interpreting the standards. And so that is the purpose of we talked about, it helps in the development of future accounting standards, also help in interpreting standards, and also when there is no standard, we use the what? The conceptual framework. We use the conceptual framework. Also, it assists auditors when forming an opinion about the true and fair presentation of financial statements. Yes, auditors are there to audit your books, to examine your books. So they will base on the general principle that you are using in preparing your financial statement. According to law, you are to follow the conceptual framework, right? So the auditors, who are the business police, auditors who are the business police, would come to you and examine your books, whether you are following the standards, whether you are following the principles. So they would take the conceptual framework and look at it and check whether the financial statement that you are presenting to them is in accordance with the conceptual framework, right? So that's why we said that it assists auditors when forming an opinion about the true and fair presentation of financial statements. It also provides information to parties that are interested in the work of the IASB. Yes, so some parties would like to know the work of the International Accounting Standard Board. What do they do? They develop the conceptual framework, and also they help in development of standards. So the conceptual framework assists interested parties to know the work of the IASB. Any question up to this point? Any question up to this point?
No, please.
Okay, so now let's go to the general purpose financial report. General purpose financial reports. All the financial statements that are available to the public that you see are general purpose financial reports. All the financial statements that are available to you are all general purpose financial statement report. So what are general purpose financial report? These are those prepared to meet the needs of users who are not in the position to demand reports tailored to meet their particular information needs. Examples of the users include the taxpayers, creditors, suppliers, the media, etc. Right? So yes, you see that it is required by every organization or a reporting entity to prepare the general purpose financial report. So that is annually. Every year they are required to prepare their general purpose financial report. That is where the report includes every information for every party. So everyone will get his or her information from that financial statement. It is general to everyone. Information will be out there. Will be able to make a financial statements. Now, what they say. Yes. So the general purpose financial statement relates to everyone. What they say. So it is prepared to every entity, to every party. What they say. Unlike the specific purpose financial report. So under the specific purpose financial report, these are those prepared to meet the specific information needs of users who have the authority to request this report for their particular purposes. So they have the mandate. They have the mandate to request for the report. So when you're going for a bank loan, the bank can request for financial statement from you that bring this financial statement. The financial statement that you give to the bank is not the same financial statement that you give to the general public. So the financial statement that you give to the bank will be tailored specifically to the bank, so that the bank can grant you the credit that you are looking for, the facility that you are looking for. What I say, But then the general purpose financial statement is open. It's on the internet everywhere. It's on the internet and it's open to everyone. What I say. So I remember when we were having the financial management class, I told you that when you take the financial statement of companies, it has the board, right? The board of directors, where we have the executive directors and then the non-executive directors. where we have the executive directors and then the non-executive directors. And then I said that um, every effective board must have more of the non-executive directors. So let me see. Let me check the internet and see which company can I get their financial statement. Oh, please, can you see my screen?
No.
Okay, let me. Okay, I believe you can see now. So let me take MTN Ghana, MTN Ghana. (2023) annual report. So this is the financial statement for MTN Ghana 2023. Hmm. So the financial statement will give you the content of what is involved. So that is MTN Ghana. Let me. So about this report, notice of annual general meeting. So this financial statement that I have been able to download is the general purpose financial report, right? It's the general purpose financial report because it's available to everyone, right? But a specific financial report will just be for the entity that they want it to go to. So if they are giving it to the bank, it will not come out to the media. It will not be on the internet for me to be able to download it, right? So this is the general purpose for everyone that needs it. So this financial statement would have a comparative. Did you have other years so that you can be able to compare it? I believe we know the qualities of financial statement. We'll come to that. So to have the financial report of what other years. So page Okay, it's board of directors. So that's page 54. Let me show you what I was talking about when um oh, mhm. So let's go to page 54. Page 54, page 54. See their values and their mission and everything. So page 54. corporate governance. The corporate governance under the financial management that I was talking about the last time. So this is the board of MTN, our board of directors. So I said that every effective board must have more of the non-executive directors, that they would take care of the executive directors so that they will monitor the activities of the executive directors, so that the executive directors will not squander the monies of the shareholders. So they are serving as the checks on the executive directors. So let's see the first one. Ishmael Yamson, board of chairman, non-executive director, NED. So that is a non-executive director. Then chief executive officer is the executive director. And then chief financial officer. The chief financial officer is also executive director. Then Ebenezer Asante is also non-executive director. Non-executive director Kofi Dazi, independent non-executive director Felix Ado. This is also a non-executive director, non-executive director, independent non-executive director, non-executive director, non-executive director. And this is who? The general secretary. So I think he will be part of the executive director. So now you can see that the non-executive directors are more than what the executive directors. So that is an effective board. Every board must have more of the non-executive directors, since they don't take active part in the business. They don't take active part in the world business. Let's quickly look at the financial statements. Financial statement report. So this is their consolidated and separate statement of comprehensive income. So the statement of profit and loss, another comprehensive income, right? So you can see that they have 2023 and then 2022. And then they have the group one and then the company one. You do the group one when you get to level 400. But for a level, it's the company one. So the group one is when they acquire a subsidiary, they acquire an additional company. So that's where they present the reports as a group, because they've now acquired another company. So now they are operating as a group. But operating individually is the company. Operating individually is what we have at the company, right? So that is how it is. The consolidated statement of financial position, right? This is the asset, property, plant, and equipment. Can you see that? Can you see that? The property, plant, the PPE. So we have a standard for the PPE. We have a standard for the right of use of assets, which is the leases. We have a standard for the intangible assets. We have a standard for investment property, and in standard for revenue for contract from customers. Revenue for contract with customers, right? So this inventory, you have a standard. So you can see that we have a standard for almost all the listed items. Yes, so that is how it is. So this is their financial statement. Let's quickly come back to what we were doing. Okay, so that is the general purpose financial reports, because I was able to download it from the internet. It makes a general purpose financial report, but a specific one is not available to you and I. Is available to the parties that requested for it. So now let's go to the objectives of the general purpose financial report. What is the objective? What is the why should companies publish their financial reports or their financial statement? why should companies present their financial statement or financial report? So one is what? To provide information to users that is useful for making and evaluating decisions about the allocation of scarce resources. To provide information to users that is useful for making and evaluating decisions about the allocation of scarce resources. Yes, we need to know how the organization uses their resources, the resources that has been entrusted to them by the shareholders. Shareholders would like to know how they are utilizing those resources. What I say. So that is the general purpose, presenting it to the general public, to the general shareholders, that, oh, this is what you are using your resources for. The monies that you contributed to form the business, this is what we are using the monies for. That is one of the key objectives of the general purpose financial report. Also, to enable reporting entities to demonstrate accountability between the entity and those parties to which the entity is deemed accountable. Yes. So you are accountable for your actions and inactions. You have been entrusted resources. So at the end of the day, you need to account to the person that gave you the resources, right? You need to account to the person. So that is one of the objectives, the general purpose financial report. You also know the financial position and performance of an entity at a period of time. The purpose of financial report is to know the financial position and performance of an entity at a period of time. So that is the key objective of the general purpose financial report. Who are the users of the financial statement? Who are the users of the financial statement? We have users, specific users of who? The financial statement. So here we have the resource providers and then the recipient of goods and services. We can also talk of parties performing review or oversight function. So resource providers, who are those who provide resource to the entity? We have employees. Employees, they are the human resource, right? They are resources to the entity. The entity will pick the employees from the environment, right, in which they operate. So they form as they are resources to the entity, human resources, right? Can also talk of lenders, right? They provide credit facility to the entity. They give the entity cash, right? Cash or in the form of loan to operate as a business. We can also talk of creditors who give out goods to the business on credit, right? Suppliers, investors, and then contributors, right? So investors, you can talk of the shareholders. And then we come to the recipient of goods and services. Who are those who receive the goods and services? Basically, customers receive the goods and services. So customers and then beneficiaries, whoever benefits from the services rendered. And then we have parties performing review or oversight function. Who are the parties who regulate the activities? So we can talk of parliament, who are responsible for forming laws, the government, the regulatory bodies, analysts, labor unions, employer groups, the media, and the general interest. So that is all for the definition and introduction of the conceptual framework. Now let's come to key characteristics of financial statements. Key characteristics of financial statement. What will you tell you that this financial statement is of quality, is of high quality? What are the characteristics? What are the attributes that would inform you that this financial statement is good? So qualitative characteristics are the attributes or qualities that make financial information useful to users. These have been grouped into two. Yes, we have the fundamental characteristics and then enhancing characteristics. So fundamental characteristics, these are the basic characteristics. You can have a financial statement without the fundamental characteristics. Then it is not a financial statement. It is not a proper financial statement. So let's take the fundamental characteristics. The fundamental characteristics. So a fundamental characteristics is that characteristic that makes information useful. In other words, a fundamental characteristic is that which, if it is absent, then it makes the information useless or misleading. If you have a financial statement without a fundamental characteristics, then in fact it is useless and it will be misleading, right? So they are the basic characteristic that every financial statement must have, right? Every financial statement must have the fundamental characteristics. So without those characteristics, then the financial statement is useless. It will be misleading, right? Then we move to the enhancing one. So the enhancing is that which makes the information, it makes the information more useful. So the enhancing one are the ones that if you don't have them, it will not make the information useful. Like without them, the information can be useful, right? But then if they are present, the information will be more useful. What they are saying, they are say, we a Jumana ultra brighten. What they are saying, you have done building the house and now you are doing painting, right? So without the painting, the house can still operate, right? The house can still function. So the enhancing one is just to support the fundamental characteristics, right? To make the financial statement more useful, right? More useful. So let us look at the examples. So under the fundamental, you have the relevance and the faithful representation. These are the key things, key fundamental characteristics. Key fundamental what characteristics. Key fundamental characteristics. What are the key fundamental characteristics of financial statement? FR, faithful representation, and then relevance. Faithful representation, and then what? Relevance. So relevance here means it should be able to influence our decision. It should be able to influence our decision. If it's not able to influence our decision, then it is not relevant. It is not relevant. For an information to be relevant, then it should be able to make an impact. It should influence our decision, right? So we said information has the quality of relevance when it can influence on a timely basis users' economic what decisions. It should be able to influence our economic decision. It should be able to impact our economic decision. Then it can say that it is relevant. It helps to evaluate past, present, and future events by confirming or perhaps correcting past evaluations of economic events. Relevant information has predictive or confirmatory value. And relevant information has what? Predictive or confirmatory what? Value. It means you can predict it. You should be able to confirm it. You should be able to what? Confirm it. That you can predict that this is what will happen. And you're able to confirm its value that, oh, yes, it has been confirmed. When I looked at the financial statement, I've been able to what? Confirm it. So predictive value enables users to evaluate or assess past, present, or future events. Means you can take the previous year's financial statement and compare it to current year financial statement to make your decision. So it assess past, present, or future events. Confirmatory value helps users to confirm or correct past evaluations and assessment. So you see that the financial information has confirmatory value if it provides feedback about or confirms or changes previous evaluations. So the financial statement should be able to we should be able to compare it to previous financial information to make informed judgment. So we'll be able to confirm. The key word here is confirm and then predictive, right? So when you hear of relevance, key things that should come in mind is that it should be able to influence our economic decision. Ability for the information to influence economic decision and should have a predictive and then confirmatory value. That is it for the relevance. Faithful representation. The framework states that for information to be useful, it must be reliable. It must be what? Reliable. The quality of reliability is described as being free from material error. Key things here are what? Material error. To be free from material error. It should be free from what? Material error. And accurate. A faithful representation of that which it purports to portray. That is, the financial statements are a faithful representation of the entities underlying what? Transaction. So to be of faithful representation, information must be complete. If you have a financial statement and it is not complete, then it is lacking the faithful representation. It must be neutral. It shouldn't be biased and neutral. Then it should be free from error. These are the three key things when you talk of faithful representation. So if they ask you what is faithful representation, they will never ask you that. Then you should know that it is complete, neutral, and then free from material error. So these are the two fundamental qualities of financial statement. Let's move on to the enhancing one, the enhancing characteristics. Can talk of the comparability. When you talk of comparability, it means that financial statement should have at least, it should have 1 year of the previous year. Means if you are preparing financial statement for 2023, you should bring 2022 financial report so that you can be able to compare it. You saw that from the MTN financial statement. They don't just prepare financial statement for 2023, that's all. 2022, that's all. You should be able to bring financial statement of the previous year, at least the previous year, so that you'll be able to compare it. That, oh, from 2022, we had revenue of 20,000. Our revenue increased to 30,000 in 2023, right? So there should be that kind of what? Comparability. So that information about a reporting entity is more useful if it can be compared with the performance for other periods of the same entity or with similar information about other entities. It must be able to be compared with what? Periods of the same entity or with what? Similar information about what? Other entities. Users will compare an entity's results over time and also with other similar entities. This is the principal reason why financial statements contain corresponding amount of previous what? Periods. Comparability is enhanced by the use and disclosure of consistent accounting policies such that users can confirm that comparative information, that is for calculating trends, is comparable, and the disclosure of accounting policies at least inform users if different entities use what? Different what? Policies. So as I said, basically it's about an entity having previous year's financial statement so that you can be able to compare it with the current year. And that would help make informed decision. Move on to the understandability, which is one of the enhancing characteristics. Financial statements must be prepared and presented in manners that a person with related reasonable knowledge would be able to comprehend it. Yes, the financial statement should be able to be understood by any person at all that takes it. What I say, you should be able to know that this is your revenue, this is your cost, these are your expenses for the year, these are your assets, these are your liabilities, these are your what? Equity. So it should be understandable. The financial information should be understood by all parties that take it. So understandability does not employ the exclusion of difficult transactions from financial statements. Full disclosure of policies and methods used by the reporting entity would aid in making financial statements understandable. The key word is what? It should be able to what? And should be understood by all parties. What does it? Timeliness. Information should be provided in a timely manner to be useful for decision making, right? Yes, you are to present your financial information at the end of what? Each year, each fiscal year or each reporting year. Why would you delay and then you would not be able to present it within that year? Moreover, at the end of each year, you are given like 3 months for you to publish it. So at the end of your financial year, you are given at least 3 months for you to make some adjustments to your financial statement and correct certain errors before you can publish it to the general public. So you must make sure that you follow the time that is allocated to you. So it must be timely. What I say. So this is one of the characteristics of the general purpose financial report. Then verifiability. Different knowledgeable and independent observers should reach a consensus that the information provided faithfully represents the economic phenomena. We should be able to verify that, oh, if an who their idea okay, what are the receipts? You said you have you purchased this asset for 30,000, for $50,000. What are the receipts to prove that what they are saying is correct? So we should be able to verify what you are saying. You must be able to lead us to a specific site, a specific location that we'll be able to find the information that you are saying. So it needs to be what? Verifiable. Accounting information is verifiable if two independent accountants can reach a consensus that a particular event is faithfully represented. So there must be an agreement that, oh, yes, what he's saying, yes, these are the receipts to prove that what he's saying is right. And yes, he's saying that he got it from here. When we went to ask the person, this is what the person is also saying. So yes, we have been able to what? Verify it. What I say. So these are the what? Characteristics of what? Of the general purpose financial report. Of the general purpose financial report. So me, I see that the first two, which is the basic ones, which is the fundamental, is known as the FR. So the FR, and then these ones can be 𝒏𝒂𝒏𝒄𝒊𝒏𝒈. That is the short acronym that I've developed. So the FR is the faithful representation. The R is the relevance. Then the 𝒏𝒂𝒏 is comparability, understandability, timeliness, and the V is what? Verifiability. The V is verifiability. So now, let's come to the next subtopic under the conceptual framework, talking of the financial statement and then the reporting entity. We have been hearing reporting entity, a reporting entity. Any question, please? Any question?
Please no.
Okay, so now the financial statement and then the reporting entity. Financial statements provide information about transactions and other events viewed from the perspective of the reporting entity as a whole, not from the perspective of any particular group of the entities, existing or potential investors, lenders, or other creditors. So you're saying that the information that is provided about transactions is viewed from the reporting entity as a whole. So when you say a reporting entity, here the reporting entity can be the whole business. It can also be a department in the business. What I say? It can also be a segment of the operations. What I say? So a reporting entity can be a segment, can be the whole organization, and can be a division or a department in the what? In the organization. So that is what the reporting entity is talking about. So now the key, what is the key assumption underlying the preparation of the financial statement? So basically, I see that there are two key assumptions that underline the preparation of the financial statement. You have the accrual basis and the going concern. The going concern, the going concern, the accrual basis and the going concern. The accrual basis and the going concern. Yes, so what is the accrual basis saying? Assumption that income is recognized when earned and not when cash is actually what? Received. And not when cash is actually received only. An expense recorded when it is incurred and not when it is what? Paid. So the accrual basis, yes, is saying that we don't really only recognize income when it is what? It is when cash is actually received. But then when the income is what? Earned. So you have worked for somebody. The person is yet to pay you. Even though you have not received the money, you can record it. Yes, I've earned this amount. I'm yet to receive the money. So far as the fact that I've completed my obligation, I have satisfied my part of the contract, then I can recognize it as what? As an income in my books, right? So that is when income is what? Earned, and not when cash is actually paid. And expense, when the expense is what? Incurred. Electricity bill, you have utilized the current, and you say that you have not paid cash for it, so you not recognize it in your books. Accrual basis is saying that so far as you have incurred the expense, you have utilized the electricity, you have utilized the water, record it in your books. Don't say because you have not paid money for, you have not actually made the payment. At the end of the month, they will come for their money. Or at the end of the specified period, they will come for their money. So you would have to recognize it in what? In your books. That is the assumption underlining the preparation of what? The financial statement, the accrual basis. Then we have the going concern basis. The going concern basis. So the going concern basis is of the view that the business would operate for the foreseeable future. If you are establishing a business and you are thinking that the business will liquidate or will terminate in just about, let's say, 2 years or 3 years, then that is not how the business must operate. It must be a going concern business, meaning that it must think that it will operate for the foreseeable future. So it must operate for longer terms, right? So these are the key assumptions underlying the financial, so that if you operate for the longer term, you'll be able to compare your financial statement. You say that, oh, let's compare your 3 years financial statement. Let's compare your 5 years financial statement, your 6 years financial statement, right? So the key assumption underlining the financial statement here are the accrual basis and then the what? The going concern basis, right?
So it
The
was
accrual basis and then the going concern basis. Accrual basis and then the going concern basis. So now let's talk about what a reporting entity is. We started talking about that. So a reporting entity is an entity that is required or chooses to prepare financial statement, that is the general purpose financial report. A reporting entity can be a single entity or a portion of an entity or comprise more than one entity, right? As I said earlier. So it is an entity that is required or chooses to prepare the general purpose financial statement. That prepares the general purpose financial statement. What are the elements of the financial statement? Key element of the financial statement. What are the elements of the financial statement? You have the assets, we have the liabilities, the equity, the income, the expenses, and the rest. So assets. Is anyone speaking to me?
I don't know why weekends are not good. Huh? If I tell you, say you go be sure. Them lash me, go to excess.
Who lash you?
Aside class the trabet.
As I was putting TSS, it's with one draw where I saw.
Who lash you?
So I be left with the child. Forget that, make you continue.
And then weekends,
Ayo. Weekends, them lash you, eh? Okay. So these are the element of the financial statement.
Hello.
Yeah, hello.
Bobo.
Is anyone having a question? Yeah, hello.
I'm in a class.
Oh, okay. She's not speaking to us.
No,
So element of the
it's
financial
not like
statement.
a main class. No.
Karine, please mute yourself. Karine, please mute yourself.
I'm in a class.
Oh, Karine, yes, we know you are in a class. Please mute yourself. Okay. So the element of the financial statement, you did it under accounting, fundamentals of accounting, and then the introduction to accounting. What are the elements? The financial statement is made up of what? The assets, the assets, the assets, assets, liabilities, equity, what else? Income,
Revenue.
the income, the revenue is under the income. The income, expenses. Yeah, so the expenses. So let's look at the assets. You know already, assets are economic resource. Keyword. So I've highlighted the keywords. Assets. In financial reporting, we don't define assets like the fundamentals of accounting and then the introduction to accounting. What is an asset? An asset is a resource that you utilize or a resource that you use in the production of the goods and services. Yes, in introduction of fundamentals of accounting, I taught you the asset as, yes, they are the resources that is used in the production of goods and services, because that was the definition for your level, right? But now financial reporting going from level 300 going, you will speak like a professional accountant. So assets are economic resources owned and controlled, keyword, owned and what? Controlled. They are the economic resources owned and controlled by an entity as a result of past event, as a result of what? Past event, which will lead to inflow of economic benefits, which will lead to what? Inflow of economic what? Benefits. Assets are economic resources owned and controlled by an entity. So the entity owns and then control the resources as a result of past events, which will lead to what? Inflow of what? Economic benefits. The control by an entity over a resource manifests in the exclusive and restrictive authority or ability of the entity to have entitlement and claims over the resource, which can be tangible or intangible. The ability of you to control the asset makes it your asset at a particular period in time. I have an asset. I have rented the asset to you to utilize it for a specific period, say 5 years. Within that 5 years, the asset is no longer mine. You're the one controlling the asset. Their asset is for you. You can recognize it in your books. The ability of you controlling the asset, keyword is what? Control. Control. The ability of you controlling the asset makes it what? Yours for that period of time. So that's what we are saying, that it manifests the exclusive and restrictive authority or ability of the entity to have entitlement and claims over the resource. Future transactions or events which have not yet happened do not create assets. So the key word is what? Past event, not future event. As a result of what? Past event, not future event. So that is the definition according to the IFRS or according to the IASB. According to our law, this is the standard definition for assets. You cannot go and say an asset is a resource that is utilized by the entity. What do I say? An asset is a resource which is utilized by the what? Entity. So now let's come to the liabilities. Liabilities are present obligation. A present what? obligation. Why didn't I highlight this thing? A present what? Obligation of an entity arising from past event. From past event. The settlement of which is expected to result in an outflow of resources from the entity embodying economic benefit. Liabilities is a present obligation. You have an obligation to perform. So it's a liability to you. I have an obligation to perform. It's a liability to me. That is why when someone say pay in advance to you, I'm a business. And so when a customer pays in advance to me, let's say he's supposed to pay 100 cedis, but he has paid 120 cedis. The 20 cedis that is on it, even though I've received cash, but then I would not recognize it as what? As an asset. I would not recognize the 20 cedis as what? As an asset. Someone will say because it is cash, so let's recognize it as an asset. Even though I've received 20 cedis, but I've not performed my obligation. It is a present liability to me. I have to provide the goods or service to the person. I'm here to do that. So because of that, I have a liability to perform. I have a present obligation to perform. So it is a liability to me. So that's why the key word is what? A liability is a present obligation of an entity